refine and precisely define the execution area, because that's, I think, for trade management more than anything is getting the identification right. And I said from the beginning, 80% of all mistakes are made by improper pattern identification, and then really getting into being there. The main problem with execution is that people just aren't prepared, where they might line up a pattern, but they might delay the execution, or they might not be executing in the potential reversal zone, and then that creates a whole slew of problems of trying to chase a trade. So the best way that I've found is that you take those 5-minute structures and look to capture chunks of moves. And I mean, there's a lot of, like, I do a lot of work on Australian US dollar, good movement, good patterns. That British pound, good movements. Australian dollar, you know, the thing I'm always asking myself is, okay, where's the next 30 pips? Where's the next 30 pips going, and why? And you know, even if something moves 80 or 100, or a big overnight move 2 nights ago off of a daily 5-0 at 102.20 in Australian dollar, that, you know, yielded 200 and plus pips and then pulled back 100 pips, that kind of stuff tells you, should give you an idea of the temporary nature and the need to be aggressive in trade management. And more, you know, we get into, and we'll talk here, is being anticipatory of anticipating moves. You know, if something moves a certain amount, and again, this gets into the different types of management styles of type 1, type 2, we really want to anticipate with especially intraday, to capture those high probability segments, because even with the type 2 moves and the 382 trailer, really for optimizing our time and for being active traders, the ability to capture these moves and nail something, say within a 5 or 10 pip range, and catch 30, that's a great trade. Where you know, even if it could go further, if you can capture that 30 pips, and that's your consistent mode of trading, and do it over and over again, you're going to get opportunities all day long. And you know, one of the things that is the drawback of my email advisory is that the type of setups, and this just kind of evolved over time, because people, the amount of updates required for shorter term setups became impossible for me to communicate. So that's why I try to send out the longer term setups with 1 and 2 profit objectives. But you know, that's something I'm trying to fix, because and figure out a better way to deliver that, because the more active management is really the best scenario for these strategies, because of the movements in the market. It can be used on a long-term basis, but a lot of times what ends up happening is that you get stopped out. You know, you could have been anticipatory of a certain move and trying to give it more time. It comes back and takes out your 382 trailer, or takes out a primary trend line, and then comes all the way back and retests that whatever entry point, then it goes. And those things, that's when it really starts to mess up with your head, because then the frustration of doing the work and then, you know, seeing these things unfold, and you know, feel like the market's starting to burn you, and not, you know, it's the market's against you. That's when you really start to lose focus of the whole endeavor, what we're trying to do. So let me just blow through this stuff, because this is you know, really important. Of all of this is focusing on using the market to define our actions. And that's what the potential reversal zone does. And the potential reversal zone, really, that whole zone concept is important because the potential, it was something when I was thinking of what's the best thing to call this, price, some people say price reversal zone. Well, then that assumes that the price will reverse. And I didn't want to convey that fact. I wanted to convey the potential nature of the patterns, that it still requires that management, that area of and price reversal zone is probably a better term for it, but it's not real. I mean, it doesn't give you that valid factor of in real trading, that its potential is that we do have an anticipated action and it's within that price range, but we still need to handle it properly. So again, this gets into the identification. As I said, we got to identify the patterns properly. We're using the secondary confirmation factors, namely the RSI. We can look at, from a broader perspective, we'll look at trend channels, the gaps, the warning signs, but that the relative strength stuff is where I really key off of the zones, the divergence types, and even in the Aussie dollar at the very end of the close on Friday had a perfect divergence with a bat structure that fell just shy. Now the bat structure in the Aussie dollar, I'll pull that up in a second, but the Aussie dollar was gave you a great entry point for a short-term trade on a 1 minute, but the larger pattern suggested it would go slightly higher to complete the bat. Yeah. But still, the RSI is what gives us those triggers for more valid execution and more valid response of what potentially could happen. And I'll bring that up right now, but we'll look at that in a minute. Sure. But and then we're talking management, and really when we're talking management, we want the proper expectations, and the expectation of using measurements, looking at the market again to clearly define what the actions should be, is all based on the same type of measurements as the patterns. When we're measuring a pattern, I'm trying to identify a pattern. We are not looking at anything but those price structures, and in the same way, we're wanting to look at certain measurements and levels and anticipate based upon those levels. So if we're looking at automatic profit targets, which is definitely one way to consider it, that helps, and we'll look at that especially in the Type 1 management. But really, when we start to combine the RSI with those structures, that gives us that consensus of what's happening on all the time frames, and getting that identification and pinpointing that execution. Then the trade management becomes more of a factor of assessing, how do we want to handle it? And sometimes certain markets you will find that certain markets have certain characteristics where it might be better to take something at a 382 or 618 than wait for a trend line violation, or look to capture something on an accelerated trend line violation more than using a 382 trailer. So there's a bunch of different ways to tailor strategies according to how the market moves. And for example, lately a lot of the currencies have been linear, really moving and on a longer term basis from one point to the next, where even if you get a bearish setup, if it doesn't really come together with a longer term number of daily or 60-minute, what you're looking at is a counter trend pullback. And those are still tradable, especially when they have good RSI structure. But for the bigger moves, not, you can't expect anything more than that counter trend move. But if it's, fits within, for example, where's my next 30 pip strategy, then I've got a valid trade execution. So within that entire, all the considerations, you're still always creating kind of a finite universe of what we can expect, and that's no matter what the trend is, no matter how far it has persisted on a daily or weekly, there are always going to be opportunities up or down that we define by the pattern itself and measuring, for example, initial profit objectives based on that pattern structure. So that's, again, where we get into using the trade management after the execution or right after a terminal price bar has been established based upon market movements themselves.